Good morning and welcome to the BF Anderson Technical Report for January the 17th. Let's get right into the charts this week. This is the NASDAQ. Now, I want to remind everyone we primarily keep an eye on the NASDAQ. It's a very large index. It is a market cap weighted index, which I'll talk a little bit more about in the future. But it's a good index to follow because it's a large index and tends to have more of the growth-oriented stocks within it. So you can see here we started to see the breakdown in the NASDAQ really didn't come to around October the 7th, October the 8th, where we broke below these moving averages and then started this correction, this downtrend. Downtrend has pretty much continued all the way into the end of the year. Christmas Eve was the low, and so far we're starting to rally off of this. And the good news is the lower moving average is starting to flatten out, possibly going to turn up. Now remember, if the index is above the lower moving average and that lower moving average turns up, that's a buy signal for this particular indicator, which is a primary indicator. Trend is a primary indicator. Now if we look at it on a weekly basis, you can see that last week was kind of promising. We had above average up volume, which means some institutions did come into the arena to do some buying. And however, we've still got more work to do here. Again, we made our low down here. A move back above 7,500 on the NASDAQ would be incredibly positive. We need to get back above this 35-week moving average, but the moving average is continuing to flatten out and turn down. We need to see a rally that can last more than a couple of days. Now, this is the most exciting thing, the high-low index. And remember, this is just a ratio measuring, and it's a relative ratio where we're trying to measure the number of new highs on the New York Stock Exchange, 52-week highs, not all-time highs. Because if you got a market which making a lot of new highs, that's a healthy market. I mean, it's telling you're in a bull market. Whereas when you've got a ton of new lows and no new highs, that's just not real healthy, and it's a lot of uncertainty. So you can see that we got down here right at the end of 18. We got down to a reading of 1.6, which is the lowest I've ever seen, and it's about as low as it got back in 2009. So this may be giving us an indication that this is pretty much washed out, that, in other words, stocks just aren't hitting new lows anymore. So in other words, before you can start any kind of uptrend, you got to stop dropping first. So this is an indication to me that maybe the sellers are finally washed out of this market, and we've now rallied back up into this normal zone, which is above 30 and below 70, and we're right in the middle. Perfect. Now you can see here by the number of new lows on the New York Stock Exchange, which we measure on a daily basis, we've only got 4 today. We had 5 yesterday. You can see we're starting to stabilize underneath that 40 a day. This is very positive. Hopefully this continues. Now, the Russell 2000 index is a small cap index. So when you start thinking about risk and risk on and animal spirits and all that kind of thing, you're going to really see it in the small caps first. Now, what I thought was interesting, when this correction started, it really got started first in the small caps. The small caps really were the first ones really to start breaking down. And so it looks like to me, if you can see this lower moving average is starting to turn up, the small caps look like they may be what leads us out of this correction, which would be very growthy and very positive. Now, here is the long-term graph that we look at, which is the 10-month moving average versus the 20-month moving average. Now, remember, these moving averages are only going to adjust monthly, so it's a very long-term process to follow this indicator. But I think it's constructive, and I think it's a good thing to look at. See, nobody looks at monthly charts. Everybody looks at daily and weekly charts. Very few people look at monthly, but Luis Yamada, who is a very respected technical analyst, says look at monthly charts. So the main thing about this chart is you can see that moving average is starting to tweak down a little bit here. They haven't even come close to getting crossing or getting any kind of bear cross. And if we can get the S&P back up above 2,700 in that range, these moving averages will start to turn back up again and we'll resume the uptrend. That's what we're looking for. Now on fear greed, again, back towards the end of the year, we got extreme fear. Like Amy said in the video yesterday, you really don't want to get too aggressive when there's extreme greed, because that means that, things are too hot. You're probably due for a correction. And sure enough, this correction really kind of got started when we got down here, back in October. of 2018. That's where everything started to go bad, and that was an extreme greed. So this is an important indicator. It's starting to normalize, but this may have been one of the best buying opportunities we've seen in a long, long time. Now, speaking of indexes, I wanted to kind of talk a little bit about this one. This is the Value Line Geometric Index. What's unique about it is it's a 1,700 stock index. Now, remember, there's only 3,600 stocks, publicly traded companies out there. There used to be 10,000. But just because the economy's been so bad and there's been no real supply of new issues or IPOs, the number of publicly traded companies has really contracted and shrunk. Well, this is a 1,700 stock index that's equally weighted. In other words, when you look at the NASDAQ or the Dow or the S&P, it's market cap weighted, which means you could have just a few companies that are the big companies in the index driving the whole index, and it's kind of deceptive, and it's not real clear whether or not you're getting a broad-based bull market. If you're just getting a real select group of stocks, it really is telling you the economy is not really doing all that well because only a few companies can do anything. So this particular graph, I went back to 1990, and it just shows you the frustration. Now, the frustration kind of got started. Now, I will say, well, our portfolios between 1995 and 2000 went up 1,300%. It was the most remarkable period I've ever experienced in the stock market. This was the dot-coms. And so if you started out with things like Cisco Systems and America Online and Yahoo and EMC and Qualcomm, and then in 97 you started getting into Amazon, this was a really very get-rich type of market. I mean, people were getting rich off of this move. But then there was the peak. Here was your bear market. Devastating. Then we got back up again to that, almost exactly to that prior high. Then we get hit with the '08 financial crisis, and things really fell apart. So if you really look at this graph, you go, you mean to tell me that where I was in 1991, by 2009, I'm at the same place, in fact, worse? This is very frustrating. Now, I'm going to say this is somewhat of a positive. I know it's going to be hard to see it as a positive, but I'm going to show you why here in a minute. Then we rallied back up to the high again, which was around the time of the election and Brexit. Then we pulled back and had a little mini bear market, rallied again, and finally, after 20 plus years, we finally broke out of this trading range on the Value Line Geometric and started to really get into a nice uptrend. But then again, we get hit with another correction, pulls us back down into this trading range box. Now, what I'm hoping this is going to happen here is that we're finally going to just kind of stabilize at the upper end of this range and then break out into a new uptrend, and hopefully it's something like this is what we're looking for. That would be the holy grail. But the point I'm making is that with all that time and all that frustration, most people, meaning the masses, are not in the stock market because the masses will not come into the market unless it's apparent. And it's just not apparent. So if this thing starts getting into an uptrend similar to the uptrend we saw back in 95, the masses are going to come into this thing and they're sitting on a lot of cash. And not only cash, but other assets that they went to that they would possibly even liquidate and move into the stock market. So basically, this is really a positive. It's just hard to understand. Now, let's get into the top five. This is Alteryx. Now, notice again, we're seeing a lot of software, mainly enterprise software, data collection, data analysis, that kind of thing. Well, Alteryx is a data analysis company. So if you're a big company and you got a lot of data, you need to analyze it. Well, this software allows you to do that. Stock is hitting new highs. Here's Crocs rubber shoes, very high profit margin. Doesn't cost a lot to make these shoes. Seems like they're kind of getting their act together. Stock's been acting really well. Okay, here we have Twilio. Twilio is one of our favorites. We own the stock. It's performing well, hitting new highs. In fact, right now I'm looking at it. It just hit another new high this morning, up in this range. This is all about this is a communication network. So it's like instead of getting on the phone and communicating, or in other words, with 5G, which is a new technology, which will be the new network. We have 4G and 4G LTE now, but we're going to 5G, and 5G is going to totally revolutionize the networks. And so this company is a beneficiary of that. A lot of these companies all these cloud-based software companies are going to be beneficiaries of 5G. Workday would be another one. Now, this is a software mainly used by corporations for human management, human resources. Now, here's a company that is also a direct beneficiary of 5G, Xilinx. They make the semiconductors that go in this thing. And the thing to think about on 5G is what's going to be really unique about it is they're going to have hardware every 1,000 feet. It's not going to be these big towers sending down these signals. It's going to be hardware on, I'm speculating here, but I'm thinking they're going to put it on street posts, street lights, that kind of thing, where you're going to have 5G every 1,000 feet. Now, this is going to be a very important technology for the autonomous automobile, because what 5G does is it speeds up everything a whole bunch, especially what they call latency, which is how long it takes once you push that button for the signal to get to the server. And if you're driving a car and a small child runs out in front of you, you don't want a bunch of latency. You want that computer to see that quick. So if you have any questions, give me a call. Things are looking much better. However, history does say we're more than likely going to have another pullback, but we'll just take it a day at a time. Thank you very much.